Hello, this is Bob Steele. In this lecture, we will continue on Chapter 13, talking about common stock. We're going to start off with a par value stock example. On June 5th, Dillon Snowboard Incorporated issued 30,000 shares of $10 par value stock for $12 per share. So what we have here is a par value and we have the market value. So when we think about the issuance of stock, remember the stockholders are kind of like the owners. When we think about the sole proprietor, this is similar to the transaction where the owner invest money in the company. So the owner puts in money into the company. In this case, the stockholders put money into the company by buying shares of stock, and therefore it's a similar type of transaction. When we think about how much money was put into the stock, we're going to sell it at the fair market value. So we're selling the stock for whatever we can on the free market. So it's 30,000 shares at $12. That gives us an increase in our cash. We sold it for cash. Cash is a debit balance. We're going to make cash go up by doing the same thing, which is another debit. Then we have to credit something. You would think we would credit common stock, which we will. And common stock represents similar to the capital account for a sole proprietor. It represents the amount of money we owe back to the owner, which in this case is the stockholder rather than a capital account. But when we issue it back, notice we have this par value. So we're putting the 30,000 times $10 gives us the 30,000 common stock par value. So we're going to have this par value, which is just an arbitrary number, and it's similar to if you think of poker chips at a casino where they're all the same thing. We're trying to basically standardize the calculation on the par value. So if we looked at this on the financial statement, we could easily see that it's 300 divided by 10, that we know that there's 30,000 shares out there. We sold it for the $12, so we could think of the difference. 12 minus 10 times the 30,000 shares gives us the 60 that we're going to put into an account called paid in capital in excess of par value. So the 30 and the 60 is actually, of course, what was paid. The 300 and the 60 is what is paid. The 300 represents the amount at par value. The 60 represents the excess over the par value, and of course the credits equal the debits in this journal entry. So if we looked at the equity section of a balance sheet, we would have the common stock, $10 per par value, 50,000 shares authorized. That's how many shares we could give out. 300 shares issued and outstanding. These are how many shares are out there at this time, and we can see that the 300 times the 10 is the 300,000. The 30 times the 10 is the 300,000. And then we have the paid in capital. So if we look at the balance sheet, the sum of these two is really what the owners have put into the company in the form of paying for the stock that was issued. And then we have the retained earnings, which represents the money that has been retained over time. So notice that the stockholders equity section is similar to the owner's equity section of the sole proprietor. The whole account is similar. Like this 425 is similar to the capital account of a sole proprietor. We just break it out a little bit differently in that we break out the investment being in the common stock and the paid in capital, and we break that out versus the retained earnings, which is the accumulation of revenue over the lifetime of the company, the retainment of the net income that has not yet been distributed to owners in the form of dividends yet. So then we have the issuing stock for non-cash assets. So we have the par value on June 10th, 4,000 shares of $20 par value stock for land valued at $105. So this is the same transaction. We could issue stock for money. We can also issue stock for something else, such as land. So instead of debiting cash, we're going to debit the land, and we're going to increase land because it's an asset. Assets go up doing the same thing, which in this case would be another debit, and we're going to put it on there for the fair market value. And once again, we're going to credit the amount of shares that were issued times the par value to come up with the 80. The difference between the 105 and the 80 would be the 25, which is going to go to the paid in capital account in excess of par so that the debits equal the credits. So if we look at a couple journal entries, we're going to prepare journal entries to record the following 4 separate issuance of stock to see the types of issuance that could be out there. A corporation issues 80,000 shares, $5 par value common stock for $700. So first thing we do is think about cash. Is cash affected? Yeah, cash is going up. We receive cash. So we would debit the cash for the 700, and then we're going to put it on the common stock on the book at the par value in this case, which is $5 times 80. That gives us the 400. Now we have the 700 minus the 400 gives us the plug of the 300 paid in capital in excess. All right, number 2, a corporation issues 48 shares of no par common stock to its promoters in exchange for their efforts. So we estimate the worth to be $800. The stock has a $1 par share stated value. Okay, so now we're going to do the same thing, but now we basically issued stock for service that was provided to us. So we didn't get cash, we didn't get land. What did we get? An organization, some type of expense, right? An expense. So in order to pay for the expense, we paid for it by the issuance of our stock. So expenses have debit balances. They generally only go up. We increase the expense with the debit. Then we credited the common stock for the $1 stated value of times the 40, and the difference between the 800 and the 40 being the 760 going into the paid in capital. Number 3, a corporation issued 40 shares of no par common stock in exchange for land estimated to be worth 800. So now we don't have to worry about this par value issue. This is actually the easiest scenario, where we just say, well, the land is going on the books for the 800, and we don't have to worry about this par thing. We're just going to credit common stock for the value that we receive for whatever we sold it for in this case, because it's a no par value common stock. And then a corporation issues 20 shares of $30 per par value preferred stock. So now we have the preferred stock, and so we're going to debit cash once again for the 900, and now we have the preferred stocks, which has slightly different rights than the common stock, and we're once again going to put that on there at the par value of 600. The 900 minus the 600 is the 300.